Welcome back, you legends. I'm Dr. Cal, and let's get right into today's video. Simple glance at the stock market map shows us that pretty much everything is in the red with the exception of defensive healthcare and consumer defensive stocks like consumer staples. Taking a look at the different sectors, market was rallying until the Fed released the projections, the forecast for the interest rates for next year and the year after that. Here it is, no interest rate hike this month. However, the Fed served a nasty poison pill to the market today. They increased their projections for next year and the year after that. It went from 4.6% next year to 5.1%, meaning the Fed only expects to cut rates by 75 basis points next year and only half a percentage point by 2025. Now imagine that the Fed is projecting interest rates at 4% in 2025. 2 years later, the Fed is projecting interest rates this high. So this was the nasty surprise. The market usually rallies at 2 p.m. and then sees a lot of volatility during the press conference and then continues rallying. There's no surprise. This time, the surprise did not come at the press conference. It came well ahead of the press conference. It came at the 2 p.m. release when the Fed revised up these interest rate forecasts. We can clearly see that 2 p.m. initial sell-off, then a small rally and continuation to the downside. All the indices are down. The NASDAQ 1.5%. The NASDAQ is on track for that 10% crash that I discussed in the last few videos. S&P 500 down 1%, Russell 2000 down 1%. Let's take a look at the different sectors. Again, look at this purely defensive rotation today. Utilities, consumer defensive, real estate, and healthcare did the best today. Communication services and technology got hit the hardest. I expect this trend to continue well into the end of October. Let's take a look at the daily chart for the S&P 500. Very clear, very obvious breakdown from this pennant. We had an initial intraday break yesterday that I discussed in the video. Here it is. This was the intraday break. And I pointed out that this break of the trend line intraday is the first hint that this major trend line is losing significance. It has now been broken once, twice, and we closed below it today. Worse yet, we made a lower high today. Now, I was expecting the counter trend rally to continue anywhere between 447 and 450, anywhere between the bottom of this gap and the top of the gap to fill it. We ended up with a much weaker rally, just back up to 440, 4.4, lower high. This looks so bad. This looks extremely bearish, way more bearish than I think the market was expecting. This will need a revision to the downside, and I will need to revise these projections to the downside. Let's take a look. I'll need to put this at the top. The revision to the downside takes the market down to 425. So now support is down from 431. I have to revise that down all the way to 425. This is now the new projection. This is now major resistance. It was prior support. I changed the color today to red, and it's now major resistance. It acted as support here. Again, here. It rejected once, twice again today with a lower high. I cannot overemphasize how bad this looks. This looks absolutely horrific. Lower high. No attempt to fill the gap. No attempt to even test the lower bound of the gap. And an immediate break of the trend line. In addition to that, look at the VIX first close above the 50-day moving average in a very long while. Why is that important? Well, I pointed out this in all of my previous videos. Whenever the VIX is above the 50-day moving average, this green moving average, the market is in a deep downtrend. Whenever we're below this moving average, the market is in an uptrend. We have now closed above it. This confirms the beginning of a new downtrend and essentially the crash that I've been discussing for days and days. Let's take a look at the NASDAQ. The daily chart for the NASDAQ looks absolutely disgusting. Look at this. So we opened below the trend line yesterday. We closed below it yesterday. We opened at the trend line today. And we had this disgusting, huge bearish engulfing candle. We are now heading all the way down to 355 in the next handful of sessions. I think before the end of the month, we will have hit this target. And by the end of October, I'm expecting this 10% crash all the way down to 332 is now in progress. This is a major break of the trend line. It held as support in all major bottoms this year. And I said the more we tag this support line, the more likely it breaks. And in the example that I always give is hacking away at a tree. The more you hack away at a tree, the more likely it will fall. The bears have now completely succeeded at breaking this trend line. There's no shadow of a doubt that this trend line is now completely broken. And there's no support for the NASDAQ at all the way to 355 and then lower to 332. On the S&P 500 daily chart, this is a very clear break of the same trend line. Initial break yesterday, that was the first hint that the market is turning bearish. Huge, massive bearish engulfing candle today. There's a very small chance that we'll see a counter trend rally to backtest this trend line. I think that is still possible. If that happens, that will be an objective short entry. The first objective short entry is today at the break of the trend line. The second objective short entry is at the backtest. I personally prefer a backtest. That would be an ideal short entry for me. And if I extend this resistance line and I move it slightly down to account for these previous supports, this is now resistance. 442 is now resistance. So ideally, the ideal scenario for the bears and the bulls to see a counter trend move potentially early next week, something like that. So we continue lower, see a counter move, enter at the counter move, and continue to ride the market down. So I'm now marking it 442.5, major resistance. Today's bearish engulfing candle on the S&P, on the NASDAQ, looks absolutely disgusting. There's no other way to describe it. It looks absolutely horrific. Volume is large, but not as large as we saw back on Friday of last week. It is still significant. The candle is still massive. We closed at the low end of the candle. This usually means a continuation to the downside tomorrow, at least intraday. If we form something like a hammer candle, then expect that counter trend rally to take place. If we open at the middle of the candle, let's say, then expect more selling to the downside. If we open at the bottom of the candle, expect some counter moves, very faint. I expect that counter move to fail at 440, continue lower all the way down to 431. We could see some buying at 436, some buying again at 435, but these are only minor supports. Let's see it on the hourly chart. This is now my new projection. If we take a closer look to identify levels, where can we find support? Where can we find potential very short-term support? Maybe at 437. I'm not convinced. It looks like a very weak level. This level looks much stronger here at 434 and 435. We've tagged it again here and here. So anywhere between 434 and 433, I expect some buying to take place. So let's adjust that forecast down to, let's say, 434, then a counter move potentially back up to 440. This is now major resistance at 440. Let me highlight that level. Here it is. This is now major resistance. Let me change the color to red. There we go. This is now major resistance. So expect something that looks kind of like this, continuation down to 434, then a back test at 440, continue lower to 431, back test again at 434, and then continue all the way down to 425. My downside target has now been upgraded, or I should say downgraded, to 425. That's this level right here. This is now the new downside target. I'll keep 431 because I do think some buyers will step in, but I think we continue lower 425 and eventually even lower to fill the gap at 421. So the full downside target on the NASDAQ is 332. That's 10% from the breakdown of the support line. That is still within the bounds of the 200-day moving average. So that's not out of the question. A 10% correction is actually common enough. It happens roughly every 15 months in the market over the last 70 years. So that's not out of the question at all. So far, let's see, we've had 265 days, 181 trading days, roughly 3 quarters without any 10% correction. We can actually go back even to October. That's 1 full year without a 10% correction. So we are due for a 10% correction on the NASDAQ. The NASDAQ continues to be my preferred shorting opportunity over anything else. On the S&P 500, short-term target 431, medium-term target 425, final target the end of the correction. I expect that to take place after we tag 420, fill this gap at 421, continue slightly lower to 420. This is a prior area of major resistance. Look at this, rejected here, rejected again. So I expect it now to act as support. And look at this, it's also extremely close to the 200-day moving average. So end of September target, still 431. Mid-October target downgraded to 425. End of October target is now at 420, still at 420. NASDAQ 100, end of September target 335, and end of October target 332. Let's take a very quick look at the futures market. I tracked the 2-hour chart on the futures legends to identify key turns in the trend, and I want to highlight something significant. Even in big pullbacks, you see the 50 and 100 moving averages get very tight, but they don't cross. They get very tight, they don't cross. Very tight, they don't cross. Very tight, they don't cross. They don't meaningfully cross. Maybe they cross down for a day and that's it, right? Just a single day and that's it. So what happened more recently? Well, they crossed and they stayed down for 2 days. For 2 days, usually that means the beginning of a new downtrend has taken place. We are now here relative to the downtrend. This area is identical to this area, so expect significant selling from this point on. XLY divided by XLP, we had a break of this ascending wedge, and we had confirmation September 18th. That was it. That confirmed the double top. I discussed this in the weekend update video. We've now also broken below the 20-day moving average. This opens the door for significant downside in the XLY relative to the XLP. I expect a sell-off all the way down to the snack line. That means things like Tesla, Amazon, expect massive sell-offs in both of these names. Summation index continues to turn down. This is the NASDAQ summation index. Remember, legends, I discussed this in the last video. Expect a double dip in the oscillator. The second dip usually comes below the first dip, right? A lower low, a lower low, a lower low. This happens consistently, a lower low. There you have it, lower low, lower low. The second low, the lower low, usually develops just before the market establishes a bottom. Let me show you with a vertical line. There you have it. That was the lower low. The market bottomed a few days later. Let's see here. That was the lower low. The market bottomed a few days later. Then made a lower low on the daily chart, higher low on the oscillator. That established a strong bullish divergence, and that confirmed the bottom for the cycle. Again, legends, look at this. Lower low, the market bottomed a few days later. Then a higher low on the oscillator. It corresponded with a huge major bottom in the cycle. We can see the same thing on the NYSE summation index, still turning down. Oscillator accelerating to the downside. Expect another big sell-off to begin now all the way to the end of September. And this is backed up by seasonality. Usually, legends, the market will top between the 11th and 13th trading days in September. This year, the market topped much earlier. It topped on, let's see, the 8th trading day in September. So this September is going to be more bearish than the average seasonality. So expect significant weakness all the way to the end of the month. This is VTV relative to VUG, value relative to growth. Value only outperforms growth when the market is bearish. Notice the outperformance began when the market topped on July the 19th. That was it. The market has been trending down, making lower highs since then. Let's take a look at the weekly chart. This is an important chart. Let me point out a few key things. We're now in a period of time that is very similar to this period of weakness in the market. If the BPSPX closes below 38.4 this week, expect significant more weakness to come. Now, unlike this period of weakness, the Fed actually came out with a second round of easing in early November. We don't expect this to happen this time. We actually expect the Fed to raise rates either November or December. So until proven otherwise, this low will likely be taken out. In fact, we are now beginning to form a very well-defined flag. So expect lower lows and lower highs all the way to 424,200 on the SPX. And then I expect a bottom to form then and begin a breakout from that point on in November, going on into the end of the year. Again, this is in line with seasonality. Expect the end of September to put in a lower low versus all the lows in September. Then in October, a lower low versus all the lows going back into early August. And then expect higher lows and higher highs to begin developing in November. So this is now the short-term projection. No gap fill. There's a very slim chance we get a counter trend move tomorrow, but I don't think that's a more likely outcome. The more likely outcome is either we open at the close, then see a very small counter rally to 439, get rejected and continue lower, or simply open at 439 and then continue lower. I think that's the more likely outcome. We could also open a lower, gap lower, with selling continuing in the futures market. Again, see a very small counter rally to 439 and then continue lower. Let's take a look at the fear and greed index, 47, getting very close to hitting fear. And we are now trending down again on the fear and greed index, still making higher low versus this low back in March and this low back in January. So the overall long-term trend is still up, but we still expect a significant sell-off and a significant correction, especially in tech, to take place. Keep in mind, legends, even with a correction all the way down to 332, a 10% correction, the market will remain in an uptrend, making higher lows and higher highs. In fact, it's very common after breakout above the 200-day to rally significantly and then come back to test the 200-day moving average. That is likely now happening by the end of October. Market momentum has swung to neutral, will swing to fear very likely soon. Stock price strength flattened and failed to break out. This is very bearish. It will now very likely swing to extreme fear. McLaren volume summation index formed a bottom, failed to produce a breakout. Expect a second low, a lower low just like this one. Put to call ratio, triple top, failed to produce a breakout in the S&P 500. Usually a triple top in the put to call ratio actually marks bottoms. We haven't seen that happen yet. In fact, the PC and the CPC are rolling over, but they did not produce a buy signal yet. Came very close yesterday, did not produce one yet. And with the significant sell-off today, I expect the histogram to start rising again and push the buy signal further back into the end of September. Market volatility closed above the 50-day moving average, this orange line. Whenever we're above it, the market is officially in a downtrend, is in a crash sequence. Whenever we're below it, the market is uptrending. We closed above it today. This signals the official beginning of the 10% crash in the NASDAQ 100. What do we have in terms of economic events? Thursday, not much going on. In fact, not much at all going on all the way into the end of September. September 29th, we have the PCE inflation data. So between now and September 29th, I don't see any bullish catalyst. We have bearish seasonality. We have the Fed coming out with that poison pill, the higher for longer, putting it on paper, raising the projections for next year and the year after by 0.5 percentage point, and still adamant about an additional rate hike this year. Overall, market looks extremely bearish. We have now very likely begun the crash sequence. This breakdown in the S&P 500 and the NASDAQ cannot be ignored. Stay safe out there, legends. This is all I have for you today. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.